Indexing. It's a life insurance idea, life insurance strategy that uses Indexed Universal Life to build up cash value that insurance agents say can then be used for tax-free income. But it's being sold in a really, really crappy way. They're taking an old idea and trying to make it brand new and say that it's better than traditional investing. It's better than basically any other options. Problem is, these are insurance agents that have no other options. They're not financial planners. They're not financial advisors. They're not licensed to do anything else. So I'm going to take some videos over the next few days and break down where they're going wrong. Let's jump in.
Should I save into my 401k even if there's a match? That's a great question. Why don't we compare the numbers side by side? Let's say you're 35 years old. You're max funding your 401k, $20,000 a year, $5,000 match. You want to retire in 30 years and you're getting a 7% rate of return without fees. You should get $2.5 million. When you retire, you want to protect that money to make sure it lasts. You want to retire for 25 years and 35% taxes. This comes out to $113,000 minus $39,000 in taxes, which you keep $73,000, best case scenario.
So let's break this down. First up, 401k max funding with a match looks good, 30 years. That's pretty straightforward. But then he gets to the investment return, 7%. Little low there. If you look at it rolling 30-year average annual returns for the S&P 500, it's going to be closer to 9.5 to 10.5%. If you're looking from 1926 to 1986, throughout that entire period, only once did the average annual return get down to this 7% range. It actually got up as high as 14% annualized over that same time period. Next up is where he really kind of gets off the mark, and that's looking at the inputs on the income side in retirement. So when you're taking out retirement income, you can really goose the numbers, or you can make them look terrible. In this case, he's making them look terrible to make his own product look better. So the balance, we'll say that number's right for conversation purposes. When you're looking at the investment return rate, 1% in retirement is not reasonable. Right now, Treasury bonds are yielding 4.5 to 5%. You can have a safe withdrawal rate of 4.5 to 5% over the lifetime of your account using a balanced portfolio. So saying that it's only going to grow at 1% in retirement, that's ridiculous. Savings accounts will make more than that. Looking at the years of payout, that's reasonable. 25 years, that puts you at 90. That's fair. But then the income tax rate. He's saying a 35% tax rate in retirement. Again, this makes the projection look terrible because most people aren't going to have a 35% rate. For a household of two, for a married couple, that means you're going to have a household income in the $300,000 to $400,000 range to have that high of an income tax rate. And that's marginal rate. I'm not even talking about the average rate, which is what he's actually projecting. So, of course, when you're looking at the annual payout amount, he's looking at a lower amount. When you're looking at taxes, he's making those taxes much higher. And so, yeah, the post-tax income here is going to show lower than what he's showing in the second part of the video, which I'll cover in another video. Big picture, this is a really, really crappy way to do it. He's not showing apples to apples, and it's frankly just very, it's kind of a lie. It's a scam. It's not a good way to compare products to show one versus the other.